What's going on, everybody? Nate Hare with Nuview Trust Company. Today, we've got another edition of our Wednesday webinar. This is one of my favorite topics to talk about. But first, before we get into it, I want to thank everybody for continuing to support Nuview Trust Company. I want to thank everybody who have been joining us. We've been getting a ton of positive feedback from you guys. So keep watching. Let us know if there's any other topics you want us to touch on. If you have questions on any of the material, I always have follow-up information on where you can send those questions in. And if you have questions during the live broadcast, which is right now, you can post those in the comment section if you're logged into Zoom. If you're watching through Facebook Live, you can post those in the comment section there, and we'll get to all your questions in due time. So again, want to thank everybody. Nuview Trust Company is now the #1 source for self-directed IRA education across the nation. We are doing a phenomenal job here in our marketing department, our sales department. We've got a long list of really good speakers that I'm really excited about coming up all the way through the month of August. We are all booked up. So, but today it's just you and I, guys, and we're going to be talking about something real fun, which is using your IRAs, 401ks, HSAs, ESAs, all the accounts that we have here at Nuview Trust Company, which all have their great tax advantages. And we're going to double down on those tax advantages and talk about how those accounts can use bank financing to help exponentially increase its growth in a tax-free manner. So let's just get right underway as Maggie pulls up my PowerPoint. We are talking about buying real estate in your IRA with bank financing. Sharing the screen. Tell me when to go, Maggie. There we go. All right. So some things that I want to mention just a little bit before we get into it is that we're going to get the difficult stuff right out from the beginning, which is the taxes that your IRA may face when doing this. Okay, I'm going to attack that right from the beginning and talk about it, but talk about it in a way to where I'm also going to offer you guys solutions if you use this strategy and how you can both minimize, eliminate this tax, avoid it completely, do all this kind of fun stuff. Because when you hear about tax and IRA, I get this knee-jerk reaction from people that they think, well, I thought I was supposed to use my IRA to avoid tax. Yes, you are. Fundamentally, how an IRA works, it's a tax-exempt trust, but there are certain occasions, certain investment activity that your IRA can do, which can trigger it or make it into a taxable entity. And we're going to talk a little bit about that and talk about UBIT, which is called Unrelated Business Income Tax. First, let's talk about what it is. In the great land that we are in America, it's the land of opportunity, and everybody has an opportunity to be a taxpayer, even an IRA. But it's not all so bad if you understand how to plan accordingly for this tax that we call unrelated business income tax. And this is a tax that kicks in when we're talking about buying real estate with the use of bank financing. But there's other circumstances to keep in mind as well, depending on what your IRA is investing in. What types of accounts can be subject to this tax? Well, all the accounts that we have here in Nuview. So you've got 7 types of plans that you can set up for yourself here at Nuview Trust Company. We have personal plans, which are your traditional IRAs and your Roth IRAs. We have employer plans if you're self-employed, which would be your SEP IRA, your simple IRA, or your solo QRP, or we like to call it 401k. We also have specialty plans that can be self-directed, health savings accounts, and Coverdell education savings accounts. All of these plans, with the exception of one, and I'll get to that in a second, are treated the same when it comes to paying unrelated business income tax, or in a specific case, unrelated debt finance income tax. Let's define it a little bit, and then I'll talk about solutions to avoid it. And I've got 2 great case studies on how current clients have used debt to help maximize the value of their IRA, even though their IRA was subject to a tax, why they would do that. And maybe it's a strategy that you want to keep in mind for your future IRA investments. So let's just define unrelated business income first. Unrelated business income, if you think about what an IRA is geared to do, an IRA is geared to help Americans save for retirement by using this, by definition, a tax-exempt trust. And that tax-exempt trust is developed to help us save for retirement by buying and selling investments within the IRA and not having to pay any capital gains tax or any other taxes. Typically, you're only taxed on what you take out of the IRA when you comes to taking distributions. So if you're taking distributions out of a traditional IRA or a SEP IRA, you're typically paying taxes as an individual when you take distributions. But prior to that, as you buy and sell investments within your IRA, there's typically no tax. But there are certain circumstances that could trigger a tax. Here's two of the reasons that your IRA might become a taxpayer. Probably the least seen that we, or the least seen scenarios that we see, but good to go over nonetheless. First is owning a business. If your IRA owns a business, you just have to think conceptually. If IRAs didn't have to pay a tax, they'd be able to monopolize any industry out there known to man. I can have my IRA buy a pizza stand, and since I'm not taxed in my IRA, I can just put all the other pizza stands out of business because I can sell my pizza cheaper than the other pizza stand owners who have to pay taxes as individuals. So when your IRA owns a business, and we're talking operating business, producing goods, services, it's a repetitive thing. It's in competition with other businesses. The IRS just says, we're going to level the playing field. If your IRA owns a business, it's also going to be taxed like any other business owner. We'll get to how this tax is calculated in a minute, but just understand if your IRA owns a business in competition with other businesses, or it's providing goods and services as a business, then your IRA would be subject to unrelated business income tax. The other situation where your IRA could trigger unrelated business income tax is renting personal property. Personal property is just anything not attached to the ground. So your table, the table I'm leaning on right now, the chair that I'm sitting on, the cameras that I'm looking at, this is all personal property, boats, jet skis. All of these are things that are not attached to the ground. So when you're buying or leasing personal property within your IRA as an investment, they deem that as business activity as well. So owning a business in competition with other businesses or providing goods and services, or the method of leasing or renting personal property in your IRA is going to make your IRA subject to unrelated business income. Does this make the investment bad? It just depends. It's not a prohibited investment to trigger tax to your IRA. It's something that you want to consider so that you can calculate those taxes within your investment strategy and find out if it's worth doing in an IRA. But keep that in mind. We're going to touch on some solutions to the unrelated business income here in a second. This is the one we're going to talk about more today, though. And this is a subset of unrelated business income. It's unrelated debt financed income. Now, this works a little bit different. Okay? When we're talking about unrelated debt, we're typically talking about when your IRA is going to buy real property attached to the ground, or it is the ground. Your IRA is buying land, your IRA is buying a rental property, your IRA is buying a commercial property, all the above. If your IRA is going to buy that property and it's going to be an all cash purchase, then this isn't relevant to us. But if your IRA is going to buy property and it's going to obtain financing to help buy the property, or it's going to buy the property and carry back financing from the seller, or it's going to buy a property subject to underlying financing. If there's debt on the property and the IRA is only putting up a percentage of the investment, then our IRA is going to be subject to what's called unrelated debt financed income. And there's two types of income that we're going to talk about today. One is if it's a rental property, we have to talk about the rental income, right? The annual monthly rental income that's generated. How is that looked at from a tax purpose? And then the other way that you make money in real estate is when you sell property, the capital gain. How is that treated when you have debt on the property or you use debt to help you acquire property in your IRA? So as we continue on, again, reminder, if we're buying property cash, we don't have to worry about UDFI. It's only when we're buying property with debt, using debt, buying property and remaining debt on the property, and so forth. But don't get that confused with just buying property cash. You don't have to pay any taxes on the profit in those situations. But when we define debt finance income, we're talking about acquisition indebtedness, okay? Any unpaid amount of debt that's incurred, either one, when we're acquiring the property or improving the property, or 2, before acquiring the property or improving the property. You have to account that the debt that you're using to help buy or improve the property is unrelated to the IRA. That's why we call it unrelated debt financed income. If you think about it conceptually, it would be unfair for someone to use $100,000 cash in their IRA to buy a $100,000 house and be treated the same as somebody that put $30,000 down from their IRA and borrowed $70,000 from a bank. Those two situations are very different. So even though you use debt to help acquire or improve property held in your IRA still owns the property. It just has a lien holder. And when it's looked at from a tax purpose, the IRS deems that money that's financed is unrelated to the IRA. So you have to pay a portion of tax based on the percent that your debt leveraged. Okay. A third example is acquiring or after acquiring or improving property, the debt that is incurred except the acquisition or improvement. So this would be things like getting a loan after the property is purchased. For instance, refinance. If you wanted to take your IRA, buy a property, and for whatever reason, you got to a point to where you had exhausted the cash in your IRA to finish the rehab. I've seen this very often. There are banks that have loans to give to your IRA, not to you personally. They would give a loan to your IRA. They would secure that loan to the property just like any bank would as a cash out refinance. But that would inject cash into your IRA so that you could finish the rehab. I've also seen people use it to where they own property in their IRAs, cash, and they want to buy another property. So they use the acquisition of debt to help generate some cash back to their IRA without selling the property. And that gives their IRAs cash to go and buy another property and maybe even use another loan from maybe even that same financial institution. So the fact that you can use debt, A, is very, very important to know. It'll help get you out of sticky situations in the event you're out of cash and you need cash in the IRA to finish your rehab or whatnot. It's also important to know because if you look at your strategy, does it make sense to spread your IRA's dollars out over multiple properties, even if you have to pay a little bit of tax to do that, and debt finance the property so you can buy more properties? Instead of just buying one property cash, you might have greater returns spreading your money out and buying multiple properties. Acquisition indebtedness also includes any liens on the property acquired subject to a mortgage or any other liens, similar to a mortgage, such as deeds of trust, conditional sales contracts, chattel mortgages, so on and so on. We don't see a lot of this often, but we're going to talk about just breaking it down real simply as to how this tax is calculated and how you can plan and even avoid it in some situations when we're acquiring debt, when we're buying property. So here's how the calculation goes, okay? General rule of thumb, and I am not a CPA, so you would actually use a CPA in a situation where your IRA is going to incur a tax. It doesn't make it bad, just means something that we got to plan for. But when we're talking about unrelated debt finance income, we're only talking about the percent that we're debt leveraged, okay? We're going to calculate that off of our rents on an annual basis, and then we're going to calculate it once when we sell the property, and we have to calculate the tax on our capital gain. But what they're going to do, or what your CPA is going to do, is they're going to look at your average acquisition indebtedness. How much do you owe on the property? How much is the note compared to the adjusted gross basis? So how much is the house worth? And then you're going to multiply that by how much the gross income from the debt finance property is. So if you're thinking about this long term, if you're buying property and you're using debt to help purchase the property, as a general rule of thumb, this calculation or this equation becomes more advantageous as you hold property long term. For example, in the example of a rental property, you may start off with, say, 40% as your debt leverage percentage because you buy a $100,000 house, your IRA puts $60,000 down, you borrow $40,000 from a bank. You're starting out as 40% debt leveraged. So your income is going to be calculated. The tax off of your income is going to be based on 40% of your gross income. But as you hold the property, and let's say that you've got the property rented out, you have renters that are paying your IRA rent, and you're using a portion of that rent to pay off the note. And as you go on deeper in time, the note balance or the principal balance of the note decreases. As you hold property long-term, most scenarios, you're going to have appreciation. So as your house value goes up and your note balance goes down, your average indebtedness, your percentage also goes down. So using debt often works best in long-term hold situations. Could it help in flip situations? Sure. But if you're buying property that's heavily debted and you're flipping it the next day, you just got to realize, well, a large portion of your profit is going to be subject to tax. Doesn't make it bad, just something to be aware of. But we have some strategies here. I'm going to show you that the case studies will show you how two clients took this concept and quadrupled the amounts of their IRAs by using debt, even though they had to pay a tax. So this is just kind of an airplane view illustration of the UDFI tax that we're talking about. Again, UBIT is the umbrella of the taxable income that we're talking about here. UDFI is a subset of UBIT. Okay. If we're looking at this chart and we're going down and to the left, that would be unrelated business income. That relates to our first two scenarios, owning a business in the IRA or leasing, renting personal property in the IRA. But today we're talking about debt leveraged real estate investments. So the difference in those two is that on the left, unrelated business income, 100% of your income is subject to unrelated business income tax. On the right, when we're talking about debt leveraged income tax, we're only talking about the percent that we're debt leveraged. And as a breakdown, we're going to talk about, you want to keep in mind the income that's being generated from that investment, the capital gains that is generated when you sell that investment. And then when you sell that investment will determine whether or not your IRA is paying short-term or long-term capital gains. Now, normally you don't have to talk about short-term or long-term capital gains. If we're buying the property with all IRA cash and we're selling it, you don't even have to have the conversation of capital gains. But when we are in a taxable situation, then that conversation becomes a reality to your IRA. But here's the thing. Now that your IRA becomes a taxpayer, you also get to use the things normal taxpayers like us use when we buy and sell property, and we have to pay capital gains tax. If it's long-term capital gains, the IRA is treated no differently than a person. You go to long-term capital gains tax laws, and most people know long-term capital gains maxes out at about 20%. So let's just say, for instance, we bought and sold the property and we flipped it a year and a day. We are 50% debt leveraged. Whatever our capital gain was, we take 50% of that, and then 20% of that 50% would be our long-term capital gains tax. If we're flipping property, again, this would go back to how we're treated when it's short-term capital gains. It goes back to you as your personal income tax bracket. But we're not talking about a person here. We're talking about a trust, because an IRA is a trust, not a person. So this is something to account for if your IRA is paying tax as a tax-paying trust. We're going to get to this in a second, and it's actually right here. So here's why you want to keep this in mind and do everything you can to at least minimize it or avoid it. Now, this comes into play, I think, more with owning a business and renting personal property. But the difference between the trust tax bracket, and this is current for 2021, the trust tax bracket and the personal income tax bracket, you'll see, are very, very different in the way that the trust tax bracket peaks at 37%, the top tax bracket, at $13,051. So it goes to the top of the tax brackets very, very quickly. Us as individuals, you have to make upwards of $523,000 to hit that 37% tax bracket. But we're not talking about people, we're talking about IRAs, and IRAs are defined as trusts. So this really hits hard when you're talking about owning a business in an IRA, renting personal property in an IRA, because you can see as soon as you make $13,000, you're paying the top tax bracket. And really, if you look at it, if you're at $9,500, you're paying 35%. So it can really eat up the amount of profit you have. And that's why you don't normally see IRAs own businesses directly. They may own through a taxable entity, but they don't own it directly in most cases. But when we talk about unrelated debt finance income tax, it's important to keep this in mind, but there's a lot of ways that you can minimize it as well, depending on how long you're keeping the property. So one thing I always want to make clear too is that, remember, creating tax to your IRA is not a prohibited transaction. Okay, you can do it. It's not prohibited. So don't get it confused with a prohibited transaction. I often hear that you're not supposed to do it. No, that's not the case. It just means that your IRA has to pay a tax. It doesn't make it prohibited. So let's look at an actual case study, 2 case studies, and then I'll get into some other solutions that are outside of these case studies. But I think these are 2 really, really good case studies. So you can understand the fundamental reason why you would get a loan secured by real estate for your IRA. Now, first, the type of loan that you get is very important. Okay, this isn't a loan that you would go and get from Chase or Bank of America or Wells Fargo. Okay, they're only giving individual loans, and individual loans, most of you guys know, and I worked in the lending industry, so we usually qualify it based on 3 things: credit, income, and assets. Okay. When you're talking about an IRA qualifying for a loan, it doesn't have credit, it doesn't have income, but it does have money to put down as a down payment. It's got equity to put into the deal. So the institutional banks that have these loans are asset-based lenders, or in other words, non-recourse loans. All non-recourse means is that the financial institution that's going to give your IRA a loan, if the loan goes into default, the bank doesn't have recourse to the IRA owner because it can't, because the IRA owner is not the owner of the property. The IRA is the owner, but it also doesn't have recourse. The bank doesn't have recourse to the IRA's other assets. The only recourse the bank has is to the actual property that it loans secured by. Okay, that's a good thing. Not that you want to go into default, but in the event of default, worst case scenario, your IRA fails to make payments to the bank only has recourse to the property. It doesn't have recourse to you, the individual, or the rest of your IRA's assets. Or in other words, we call it asset-based lending. I do have a webinar set up with the president of the largest non-recourse lender in the nation. That's North American Savings Bank. There's a lot of great lenders out there. Equity Max out of Florida is another good one. We've done a webinar with them before, and we plan to do some more things with them. First Western Federal. I'm not pitching any of these companies. I'm just giving you guys some names if you want to research their rates and their terms. First Western Federal, I believe their website's myiralender.com. And there's a host of other lenders out there that have IRA loans. But remember, if you're going and searching for these loans, you got to be very specific with the loan officer and let them know this is not a loan to me, the individual. This is a loan to my IRA. And when we take out those 2 qualifying factors, credit and income, a bank, to leverage their risk, they're going to want a larger down payment. So most of these lenders, these non-recourse lenders, because they don't have credit or income to qualify, they want at least, I would say, general rule of thumb, 30 to 35% down on income producing property normally. Because again, the bank has to weigh out their risk. If they're going to loan on a property, most traditional financial institutions that do non-recourse loans, I've seen they don't like loaning on land because the land value is subject to just appreciation. There's no residual income coming in from rents, most likely. So some lenders won't do land, but they'll do anything that's income producing property. So your single family residence, duplexes, triplexes, multifamily, commercial property, and depending on the level of risk, they may go 30% or 50% down, just depending on the circumstance. But again, it gives your IRA the opportunity to leverage other financing outside of the IRA to potentially buy more property or just make more bang with your dollars. So here's a scenario where a client actually did take their IRA and they did get a loan on a piece of land. I know I just said that most lenders won't loan on land, but that was a purposeful thing. Is I want to talk about how he got this loan. He went to his local community bank, and a lot of you investors know, especially if you're full-time real estate investors, you usually have relationships with 2, maybe 3 banks. And one of those banks is usually a small community lender that you've got money parked with, because they're very flexible in a lot of cases to basically create a loan program for you. If you're doing good business with them, you've got other assets parked with them. And this was the situation with this gentleman. He was a doctor. He had all his money, with the small community bank. But he found this land that he wanted to buy with his IRA. He didn't have quite enough money in his IRA to buy it, but it was a great piece of land. There was development going on. He thought it was a good hold, at least for a year. So he wasn't trying to flip the property. He wasn't worried about short-term capital gains, blah, blah, blah. He wanted to buy and hold the property for appreciation. So the purchase property of the land was $351,120. He negotiated with his bank that the bank would give his IRA a loan for $245,600. The loan terms was a 20-year fixed non-recourse annual payments, and those payments were based on an 8.15% interest rate. I will tell you, shopping interest rates, I've seen them anywhere from 6% and up. It's good to, look at different lenders and see, who has the best rates. But sometimes, like with this gentleman, he had to go with the community bank because they were the only ones that would offer him this loan because the underlying asset was land. So the only amount of cash he had to come up with after closing costs and all that was only $109,912. Okay, so he only had to put up a fraction of the purchase price. The rest was financed from his community bank through a non-recourse loan with the IRA as the borrower. 18 months later, he went under contract to sell the property, okay, and made a pretty handsome profit. Now, remember, he borrowed money to help buy this piece of land, so he's got to pay some tax. He didn't have any rents on the property, so he didn't have to worry about paying any tax on any residual rent income, but he did have to calculate the long-term capital gains because he held it longer than a year and a day. He pays long-term capital gains. Now, remember, his IRA is in a taxable situation. So now that the IRA is a taxpayer, it can use depreciation, it can use any expenses, it can use all the other things that we would use to help whittle down the tax. If we were buying this personally, it only gets to use a fraction of it. However, whatever the fraction is, compared to his debt leveraged percentage. So when you actually looked at it, when he came down to having to pay the tax, the unrelated debt finance income tax he had to pay out of his IRA was only $10,073. Here's the key to this story. Even though he had to pay a tax, when you look at his net profit after paying tax, which was $89,497, if I rewind this and show you what he put into it, remember, he put in $109,000. So he made 89, he put up 109. If you're looking at this from a cash on cash basis, he made 81.42% in 18 months, cash on cash. Did he pay a tax? Yes. But keep that in mind, that cash on cash return on investment was quite high. Let's look at it hypothetically if he would have not used the non-recourse loan. If he did without the non-recourse loan, the purchase price would have been the same. The sales price would have been the same. His net profit would have been different though, because he had no tax, no loan payments that he had to account for. Okay. So he's going to have more profit, but remember, he has to put in this scenario without the financing, he's got to put 100% of the purchase price up from his IRA. So if he had to put up $351,120 and he only made $129,270, his cash on cash returns 36.82%. So you can see just on that simple scenario how much it made sense to use his IRA and use the debt that was available to his IRA to help exponentially increase his cash on cash return. Now, he was maybe doing this because it was all the cash he had in the IRA. So the financing allowed him to do an investment he wouldn't have been able to do otherwise without financing. Or maybe he's buying 3 pieces of land. Maybe he's got more money in his IRA and he wants to buy 3 pieces of land and all 3 of them make 80% or whatnot. So again, everybody's situation is different, but you can see in this scenario how the cash on cash return is important and how it can be increased as you use debt from a non-recourse lender. Now, I will point out this, a non-recourse lender doesn't have to be from a bank. A non-recourse lender can be anybody willing to loan money, provided it's not a disqualified person. It can't be you loaning money to your own IRA. It can't be your spouse or your kids or your parents, but it could be your brother's IRA that makes a loan to your IRA. It could be just another IRA from maybe another Nuview client that doesn't have an investment that wants to make a loan to your IRA, where maybe it makes more sense to do it that way because their IRA, they don't want to own property in the IRA, but they would rather own a note to your IRA. So an IRA can actually loan to an IRA. The only main thing is that in that note, it has to make sure that there's language in there that says this loan is non-recourse to the IRA owner, the IRA's borrower, and it can't be recourse to the IRA's other assets, only recourse to the property. So important to know, IRAs can loan to other IRAs, private money can loan to IRAs. It doesn't have to be a financial institution, but it does have to be non-recourse. Here's another one that I really love. This is one of my favorite case studies of all time. This is a friend of mine out in Texas. He was able to buy 3 warehouse units, different, not using a bank financing, but he bought 3 warehouse units and carried back a note from the original seller. Really good story. So let me tell you the story behind this one first. So My friend is a real estate investor, really good real estate investor, real bright, had a small Roth IRA that he had set up and didn't really do much with it up until this point. Ran into a motivated seller / tired landlord. What happened with this is these were 3 warehouse units that were owned and operated by a husband, and unfortunately he passed away. Those properties then went to his widowed wife, who didn't really need money, but she definitely didn't want the headache that came with running 3 warehouse units. What happened was kind of unfortunate. As the properties came down to her, and she just wasn't in, she was at a state of in her life, she didn't really want to deal with the tenants. These properties were pretty run down in kind of a northern part of Houston. Nobody was really looking at buying these properties, but she just didn't want to deal with the tenants. The tenants started taking advantage of her. They stopped paying the rent because she wasn't very aggressive. She didn't have a property manager. So it just became more of a hassle for her to even have the properties. She didn't necessarily need the money. So the properties were always managed by her husband, and in steps the real estate investor who comes to help solve this solution. So as he's getting the story out of her and realizing, well, it's not necessarily the houses that she, or the warehouses that she needs sold, it's really that she just doesn't want to deal with the tenants. So he said, well, maybe we could structure a deal where I deal with the tenants for you, and you get the same out of it, what you would normally get if you were actually getting all these people to pay rents. But in exchange for that, he said, what if we carried back a note? I've got a little bit of money in my Roth IRA, $7,000 to be exact. He said, what if we structured it to where my Roth IRA bought these 3 warehouses, but bought it on terms? Carry back a note to her for $95,000 at 9% interest for 10 years. Okay. The reason he backed into that interest rate, and this is again very creative on his part, is he asked her what she would normally be getting on a monthly basis if the tenants were paying rent. She said about $1,500 or so. He said, well, okay, 9% seems to make sense, where if I was collecting these rents for you and alleviating that headache and getting a property manager in there, their payments would come to my Roth IRA, but there's enough money in there if they're paying on time every month to give you $1,500 going forward. Would that be appeasable to you? She said, most definitely. She doesn't have to deal with the tenants. She just gets the money through the note payments that are going to be paid out of his Roth IRA. Now, the Roth IRA is going to take title to these warehouse units, but he's a more savvy investor. He does this for a living, and he has the resources to put in place to where he can make sure that the tenants pay rent. The transfer of title is going to go from her name to the name of his Nuview Roth IRA. So in this case, the new owner is Nuview Trust Company, FBO, his name and Roth IRA account number. And the collateral for the down payment and closing costs came from the Roth IRA. So it was only a $7,000 initial investment from the Roth IRA, and he was able to retain title to 3 warehouse units. Now, the debt leverage percentage on this is very high, right? It's 95%. If he was to flip all 3 properties the very next day, well, then 95% of his profit would be subject to tax. But he didn't do that because he's a little bit smarter than that. What he did is he actually held the property for 16 months, made sure that the renter started paying rent. He may have kicked out a tenant who wasn't paying and put in a new tenant who would pay. But basically what he did, long story short, is he got 3 paying tenants right away, okay, just by switching the owners and putting a property manager in place. Okay. 16 months later, after generating some rents, and again, those rents are going to help pay the payments to her on the note that he carried back, he was able to find a buyer for warehouse number 3. Okay, one of the warehouses he was going to sell. The cool part about this is as soon as he sells one of those units, that cash goes back into his Roth IRA. And he didn't just keep the cash in there. What he did is he paid off the note to the original owner, to the original seller. So he used the profits from the sale, made some additional contributions to the Roth to make up some of the difference, and even converted a little bit money over it from one of his traditional IRA. But basically, he wanted to get rid of the note. Because when you get rid of the note, you get rid of the debt, which means you get rid of the unrelated debt finance income. So the sooner you can get rid of that debt, the sooner that the income tax, it goes off the table. So he was able to retain 2 warehouse units through the sale of 1, title still owned in the name of the IRA. And when he looked back on it, what he ended up having to pay, when you look at his initial investment and the amount he had to pay in unrelated debt finance income tax when he sold that 1 warehouse unit, was about $16,000 total investment. And now what he's got is he's got 2 warehouse units owned free and clear in his Roth IRA, that the appraised value on both of them is upwards of $200,000, that are still cash flowing with a net cash flow of $1,050 a month to his Roth IRA. And because this is a Roth IRA, it's completely tax-free and penalty-free for life. He could take out his contributions that he made if he needed to, tax-free and penalty-free, but that's not his plan. He just wants to keep this investment activity going, because by the time he reaches age 59 and a half, every dime that his Roth IRA turns into tax-free and penalty-free buckets of money for the rest of his life. Now, could he sell some more? Could he sell another warehouse and then buy more property? Yes, but he's already gotten rid of the debt. The debt's gone. Now he's just got free and clear property that he can buy, sell, and buy more property and continue to grow that Roth IRA. What a phenomenal strategy. Other accounts that I think work well in this situation, I think this is on the next slide, would be these plans. So if you're going to enter into a transaction that would trigger a tax to your IRA, I would say the better plans to use would be, like he used, a Roth IRA, a health savings account, or even an education savings account. And the reason why I say those accounts is because those accounts will grow tax-free. If you're doing these transactions in a traditional IRA, a SEP IRA, or a simple IRA, it's not the end of the world, but it's almost like you're double taxed. You're taxed on the investment income as you have to incur the tax and the debt that you've acquired, or if you own a business, you get taxed on the investment profit, but then you also get taxed on the distribution. So it's probably more appeasing to use a Roth IRA, health savings account, or an education savings account, because you don't get taxed on the growth in those accounts. But if you are using a Roth 401k, here's one really cool thing with the Roth or with the 401k actually in general, is that it actually solves one of your problems when it comes to UDFI. I'm kind of skipping to number 5 there. When it comes to owning debt leverage property in a 401k, one of the cool things with the 401k is that you don't even have to pay the UDFI. It's just a special exemption that's built in to the 401k where you don't have to pay the UDFI. This doesn't account for UBIT. You can't own a business in your 401k and get away with paying the tax, but you can get away with paying the tax if you own debt leverage property in a 401k. Other solutions to UBIT, if we go back up a little bit to the beginning of the presentation, this is more for, I would say, owning businesses, renting personal property if you're doing that. But I've seen this more often when an IRA is going to own a business, or when a group of IRAs is going to own a business. If you're going to own a business, remember, somebody's got to be a taxpayer. IRS isn't going to allow you to just not pay taxes, even if it's an IRA that owns it. So you can either allow the IRA to pay the tax at its trust tax bracket level, and we saw how high that is, or you can create a taxable entity that pays taxes on a corporate level. So for instance, a C Corp. So I've seen this happen where you have 10 or 12 IRAs that want to invest in a business, and they know they're not going to escape the tax, but they want to minimize the tax. The company's going to make lots of money. They don't want to have to pay 37% right at $13,000, which is what an IRA would have to do if it was the end owner. But what they do is they set up a C Corp. C Corps are corporations that pay their own taxes, but they pay it on the corporate level. That way, the taxation is spread out amongst higher dollar amounts. And you see this quite often when we're buying stock, in stock and like Coca-Cola and things like that. These are C Corps. These are larger organizations. And it works well to minimize the tax because the tax is paid within the corporation. And as they remit dividends back to the end owners, which would be the IRAs in this case, it goes back tax-free to the IRA. So the taxes are paid at the corporate level. Now, this doesn't work well if you have people and IRAs invested at the same time. Not so much for the IRAs, but the people don't like it in some cases because they get double taxed, right? The tax is taken at the corporate level, and then when they get distributions, because they're a tax-paying person, they have to pay taxes too. So again, with every solution, there's always a pro and con to every solution. There's no magic paintbrush that just clears all problems from all people. You just want to associate the right solution with the right problem that you have. So investing through a taxable entity helps in the event that you have IRAs or groups of IRAs that want to own a business or rent personal property. Another way to just eliminate it and not even worry about it is loan, don't own. we have more clients that actually will loan on secured by property than own property. So again, it's just really up to your strategy. Loaning is great if you want to be passive. You're probably not going to make the home run returns that we saw in our case studies. But if you're just not interested in doing anything fancy or worrying about, filing the tax form to pay your taxes out of your IRA, then just loan, don't own. I do a lot of loans. It's easy. It's less paperwork. Everybody's different. Another way that you can eliminate the tax is by just taking an option. Having an option to buy property gives you different exit strategies. We'll do a class on options later down the road. It's a little bit more advanced strategy, but I really love options. An option is just a one-way contract where you have first right to buy a property, but you have exit strategies with that agreement, which is you can back away from the deal, you can cancel the option for a fee, you can exercise the option, but having an option to buy property is different than owning property. So taking an option sometimes can cure those cases of eliminating the tax, the UBIT tax or UDFI tax. Another way that you can do is bring in a money partner. So instead of bringing a lender, bring in a money partner. Now, I've seen this work well. I'll give you an example just off the top of my head. I had a gentleman that owned a piece of property in his Roth IRA. What sat on it was a hoarder house. So this house needed to be bulldozed, taken down. It was in a rough area of town, but this area was actually kind of up and coming. There were some nice apartment buildings that were going up down the street. So the land value was pretty valuable that the Roth IRA owned, but the house just needed to go. He didn't have the money in the Roth IRA to make that problem go away. So he had a couple options. One could be he can go out and have his IRA shop for a loan, but there's really no structure on this property. There wasn't many lenders looking to be a lender on a property to bulldoze a property and then build something brand new. That's very risky for a traditional bank, right? So, but what he did find is he found a money partner. Now, this money partner happened to be somebody that had a construction company, okay? Personally, had a construction company. And what they agreed upon was they weren't going to do it as a debt financed investment. What they did is they just drew up a joint venture where the IRA was the entity bringing the land to the table. And then the construction company was going to bring all the sweat equity to the table and the construction costs. And as a part of that joint venture, what it read is that once they built the structure and once they sold it, the Roth IRA and the construction company would split the profits 50-50. It worked out to be a tremendous deal for the Roth IRA because it ended up making upwards of $297,000 tax-free because what they built was a triplex, and this is in the downtown part of Houston. So again, bringing in the money partner could help alleviate the problem of the tax because when you have partners involved, there's no lien, there's no debt. It's one party's bringing the sweat equity, another party's bringing the money to the table, or the land in this case. Those are partners. There's some different things, pros and cons that you have to look at when you do joint ventures. This isn't the topic today, but bringing in a money partner could alleviate the tax because you have a partnership, not a lender-borrower situation. Or like I mentioned, is you use a solo 401k or a QRP. This is specific to unrelated debt finance income tax. So if you're going to buy debt leverage property, God, what a great tool to use, which is that 401k. So if you're a business owner, if you've got a solo 401k, if you don't have one, give us a call. We'll see if your needs match up with the solo 401k. As long as you don't have common law employees and you've got some self-employment income in order to make a first year's contribution to legitimize the 401k. The 401k is a phenomenal tool that allows you to make large contributions, and those can be Roth contributions, but also allows you to buy debt leverage property without paying any UDFI. There's a built-in exemption to that. Really cool stuff. So moving on is I'm kind of wrapped up there, and I'll take some questions if you got any. Do you see any questions there, Maggie? I've been kind of going. Hopefully this is helpful to you guys. It's actually one of the topics that I really love, coming from the lending, coming with a lending background. I was almost more mad that I wasn't shown this back when I first got into the business. I really had to work for a self-directed IRA company to even learn that this stuff was possible. Using an IRA to buy real estate, only 5% of Americans even understand you can do that. And then going forward, knowing that your IRA can borrow money from banks, institutions, or other IRAs, it's just a great way to leverage smaller IRAs and buy more and more property. So Question, can we send the presentation out? Yes, of course. Here's the cool thing. If you guys continue to register for these classes, if you can't watch it live, we always email over the recording. Once we get it polished up, we've got a phenomenal videographer named Clay. He polishes up, makes it nice, makes me look thin. You're gonna make me lose 10 pounds, right? Because I need 15, so makes me look slim, all that good stuff. So by the time you get the recording, it's nice and polished up for you guys. So all you got to do is just register, tell your friends to register too, so they get copies of the recording. Another question, when the property is sold by the IRA LLC, what is the tax rate? So with an LLC, LLCs are normally just pass-through entities. So your tax rate with an IRA owned LLC is just going to be whatever tax rate the IRA is at. So if you go back into the presentation, looking at that trust tax bracket is where you're going to look at what tax bracket your IRA falls in. Now, if your LLC is running a business, well, then 100% of your income is going to be subject to unrelated business income tax. If your LLC owns debt leverage property, then it's just going to be a percentage of the income based on whatever your debt leverage percentage is. What I would suggest is if you guys have investments like this or thinking about it, find a CPA that understands UDFI and UBIT. There's a handful of them out there. I know that there's some really good ones. Usually real estate attorneys are really good resources. They've kind of dabbled in this or might understand it, but you want to have a CPA that understands specifically unrelated business income tax and unrelated debt finance income tax. They may be attorneys too that work with other non or tax exempt entities. So IRAs are not the only tax exempt entities. It might be a CPA for a church. Churches are tax exempt entities, but every once in a while, they may have a bookstore attached to the church. Now, when the church has a bookstore or a pizza shop or a cafeteria, that the functionality of that side business is unrelated to the function of the church. So whatever happens within the church, they don't have to pay taxes on that income. But if they set up a bookstore or something else that increases some residual income, they also have to file the same form, which is called a 990T. So maybe a CPA that actually works with them is familiar with it because IRAs and church are tax exempt entities and they file the exact same tax form, which is called the 990T when you have to pay taxes. Let's see. In other words, the gain rate in the LLC sells a rental property or flip. Yeah. So, I mean, when you're talking about the rental property, regardless if it's owned in an LLC, if you have debt leveraged property, remember, debt leverage property, you're going to have to look at what your IRA owes in taxes on an annual basis. That would be through the rents. And then the one time when you sell the property, you got to factor in the capital gain. I will tell you this. When they look at the capital gain, they don't look at the entire lifespan of the debt. So if I took a property over and had debt on it, let's just say it's 50% debt leveraged. If I sell the property 10 years later, they're not going to go back all 10 years and figure out how much debt I had for 10 years. When it comes to the capital gain, what the CPA is going to do is they're just going to look at your past 12 months of indebtedness. So when you sell the property, they're going to go back 12 months and average the indebtedness on each 12 of those months. And that is going to be your running average, I guess you would say, as far as your debt leverage percentage. So again, it always helps to hold property so you have time to pay the note down and you have time to recoup some appreciation. In a perfect world, here's how you would do it. Let's say you hold the property long term and then you pay the note off at whatever time. You get some more money in the IRA, you get some other form, you make some large contributions, some principal pay down, whatever it may be. You pay the note off. From that point on, if you own it another 12 months, you can sell the property and pay no capital gains tax. So when we're talking about the capital gains tax on selling the property, they're only going to look back on the past 12 months of indebtedness. Very, very good to know. Where is the interest payments and on land ROI? I'm not quite sure what that question. Where is the interest payments on the interest payments were factored in there in the land scenario? Remember, they were annual payments, so there was factored in there as part of his net costs. So that is factored in there. Most banks, most institutionals are going to have monthly payments, but remember, in his situation, he was a doctor that negotiated a non-recourse loan from his community bank, and they basically just developed a loan to give to his IRA. Most of the lenders are still going to want 30 to 40% down, and in his case, he did put that amount down. And when it comes to making the payments, important to keep in mind, your IRA must make those payments. So in his situation, since he's not leasing the land out, he's not running a lease or doing anything on top of the property other than just holding it, he's got to make sure he's got enough money in the IRA to make the payments, okay? If it's monthly, annually, whatever the case may be, so that he doesn't go into default. When you have income producing property, and this is why you'll see more banks willing to do loans on income producing property, is they know if it's in a good area, most likely you're going to have that property rented. The renters pay rent to your IRA, you take that money and you pay the bank. Right. So as long as you can keep that process going, but your IRA at the end of the day is responsible for making those payments. Make sure there's enough cash in there to account for any vacancies. What happens if you get to a point to where it is vacant and you don't have money in the IRA? Well, you've got a couple solutions. I would always ask, have you made your contribution for the year? Remember, the one thing you can't do is if your IRA goes illiquid and it's got payments to be made, you can't make the payments directly out of your pocket, the person, and pay it for your IRA. That would be prohibited. But you could make contributions to your IRA and have the IRA make the payment. So in a lot of cases, if you haven't made your annual contribution, a lot of times that accounts for that. If it's a Roth IRA, I've seen people do this quite often. They might have bought a property, debt leverage in their Roth IRA. They've exhausted their contributions. They already made their contributions for the year, and they can't get more financing to help account for vacancy or account for something that the Roth IRA has to pay. My next question would be, do you have a traditional IRA? Do you have a SEP IRA? Do you have an old 401k? Can you convert some money from one of those pre-tax accounts to the Roth IRA in order to help make the payments? Because how the Roth and the traditional, how they're taxed different, you can't just have a traditional start paying for expenses of a Roth IRA owned asset. You got to figure out a way to get more Roth money in there or convert some money over from your pre-tax accounts and convert it to your Roth IRA. John B says, is it better to use a Roth IRA versus just taking the money out and buying property with 20% down? Then if you will, you can use a 1031 exchange and defer any taxes. Yes. So remember how a 1031 exchange works, guys. You're just deferring the tax, but you're not making the tax go away. So I would definitely not take money out of a Roth IRA, which grows tax-free, to take it out and buy property tax deferred. It just doesn't make sense. Especially if you're going to defer the taxes to the end, just use the Roth IRA to defer all the taxes. And then once you have the Roth IRA open for 5 tax years and you're above the age of 59 and a half, your entire Roth IRA becomes tax-free and penalty-free forever. The other thing that I see oftentimes, and again, I'm not against 1031 exchanges, but I know how they work. And I know how investors treat them when they've sold a property and you've got money sitting in there and you've got X amount of days to find a new property of equal or greater value, and you have to close on that property equal time. I've seen people just throw their money in investments just because they're trying to defer the tax and they're trying to beat the deadline. That's great if you're trying to defer your own personal taxes, but using an IRA, especially a Roth IRA, is so much easier because there's no time frame. You could sell a property and just leave the cash sitting in there and buy a property 2 years later. There's no time frame as to when you have to find equal or greater, and it doesn't have to be like property. So if you want to buy a single family property, sell it and then buy an apartment building, you can do that. If you want to buy an apartment building, sell it and then buy cryptocurrency, you can do that, and all the profits deferred. But if you're using 1031 exchange, you're limited as to what the investment could be, and you're limited on the time in which you have to execute on those properties. Again, it's great outside of your IRA, but I would never take money out of my IRA to do 1031 exchange. I just don't see the purpose for that. Good, great question though. Let's see, skipping through, and I'm not going to get to all these guys, but I will get to them in emails with you guys, or even call you guys if you need to. Here's a question: have a solo 401k and an SDIRA. SDIRA has more money than the solo 401k. Can I partner my solo 401k and SDIRA to invest in real estate investment? You can. So, and we have a lot of clients that do this. They have IRAs and they've got a solo 401k. The solo 401k, great advantages. We've mentioned one, which is you can buy debt leverage property and not have to pay any taxes. My first initial question off the top of my head, without giving tax advice, is I would probably ask you, what are your self-directed IRAs? What type are they? If it is a traditional IRA, if you're investing the traditional IRA and you're partnering with your solo 401k and you're buying debt leverage property, well, you're not going to alleviate the UDFI to the traditional IRA. So does it make sense to just roll the traditional IRA in the solo 401k? That way you get the exemption. One weird thing about solo 401ks is they don't allow you to roll Roths into a 401k, even if it's a Roth 401k. So if you have a Roth IRA and a 401k, you got to keep them separate, and you can partner them. Again, great partnering is great. It gets both buckets moving, even if you have to pay a little bit of tax on the Roth portion on your debt financed percentage, not the end of the world. But if you've got money in a traditional IRA, maybe it makes sense to roll the money into the 401k and have the full exemption for the retirement money that you're using. Could we get a copy of the slides? Yes, most definitely. We're going to email that to everybody that has registered. So everybody, if we got your emails, and I've got so many good questions. Woo, you guys are just, I love it. I'm not going to be able to get to all of them, but we can save these. I can save these, right? And get to all of them. I'm going to get to everybody's question privately in emails, and you guys will all get copies of the presentation. I love doing this presentation because I always get such great questions, and it's always a good conversation starter. And I will make sure everybody gets their questions answered. So let me wrap up here. I want to make sure these are saved. Cool. All right. And just get to anybody who's out there who is not a client. First, I want to make sure that you guys understand Nuview Trust Company, we're going above and beyond what normal custodians are doing these days. One thing that I will mention is that we are, as far as I know, we are the only self-directed IRA company that allows you to buy alternative investments, traditional stocks, and cryptocurrency. We are now set up as of today to trade cryptocurrency directly through your self-directed IRA. Now, I know this isn't the topic, but what's important about that is a lot of our clients have small amounts of cash, 5,000, 10,000. And if you're not doing something real creative, or you just don't have time to go out and find it, that money sits there like a rock. So we are open up to give additional opportunity for you to trade through a TD Ameritrade account if you want to buy traditional stock, and that's through your Nuview account. And you also can buy crypto now. We're going to be doing a special webinar on that, coming up with one of the sales reps at ErisX, which is the platform that we are partnered up with. But it is very, very easy to do. It doesn't require you setting up an entity to do that, and yada, 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 yada. I don't want to get off too far off into the hole there. But, you know, with all that being said, too, we're one of the, when it comes to value, I mean, there's no better value than Nuview Trust Company. Our fees, looking at, and I look at this on a daily basis, I compare our fees to the industry standard. You know, we're anywhere from 20 to 30% savings on any account that you would open. And the larger the amount is, the larger the account is, the larger the savings is with Nuview. So if you're not a Nuview client, reach out to us. Even if you're with a competitor, love all our competitors, but if you are getting overcharged right now, you might want to look at getting charged more of a value plan. And we've got those here at Nuview. So again, very, very inexpensive to self-direct your IRAs here at Nuview, and we've got a ton of education that help you, you know, locate the best investment for you. So your best investment decisions can be made through the education and content that we're providing. And we do have a promo through the end of June. If you want to open an account, I would suggest first emailing info@nuviewtrust.com so that one of my IRA specialists can reach out to you and just give you a quick consultation. The consultation doesn't cost you anything. It's just really to make sure that we are opening the right accounts for you and making sure that you understand all the tax advantages and how the process works. But through the month of June, we're going to waive all account opening fees for any accounts you want to open. So this goes to current clients too. You know, we kind of mentioned Roth IRA. I talked to a great client this morning who had a Roth IRA, and we started talking about the HSA. You know, most clients, even current clients, I would say probably need one or two more accounts. They just didn't have time to think about it. Well, now's a good time to think about it because we're not charging any application costs if you want to open accounts. So that goes to an unlimited amount of accounts you want to open for you, spouse, and your dependents. Again, we've got 7 different accounts you can open, so that can be a large savings. And just to give you kind of a airplane view of what classes we've got coming up in the month of June, and live event that we got coming up in the month of June. Good friend of mine, Ed Pugh in Charlotte. He runs or is a moderator of one of the largest, maybe the largest real estate group in Charlotte. Went out and visited with him. Great guy. Great knowledgeable investor too. He does his own classes in Charlotte. So what we decided to do is we're going to team up together, and we're going to actually have a class with me and him, and we're going to talk about real estate horror stories and how to avoid them. He's got some great stories about things that he's encountered as a real estate investor through his many years. And then I've got some case studies on some horror stories that are specific to IRA. So that's going to be a really fun one. We're going to learn a lot in that class. And then we've got Fernando Angelucci on June 16th, where we're going to talk about self-storage. He is an expert when it comes to buying and operating and selling self-storage units. So we're going to talk about how that applies to an IRA. Got our good friend Charles Sales with the PIP group, who are very familiar in buying and acquiring basically turnkey properties. So we're going to have him as a special guest on how you can strategically and passively invest into real estate through your IRA. And for those of you who are in Florida or who want to take a trip, jump on a plane and come visit us in Florida, we're doing a night with Nuview, which is going to be a networking event. It's our first networking event post COVID. We're going to do it safe. We've got rented out a space at the Orlando Science Center, which gives us the opportunity to be outside as well if you feel more comfortable being outside. But this is our first shot at 221 to doing a live event. We're expecting anywhere from 100 to 150 people. And that goes to clients and non-clients alike. The event is completely free, and it's going to be from 6 p.m. to 8 p.m. Quick event, hors d'oeuvres, all that stuff. It's going to be real fun, and get to shake hands and meet all you guys. So go to our website and register for these. Make sure if you register for the webinars, you'll get a copy of the recording, like I mentioned, and register for the night with Nuview if you're in the area of Orlando or would like to come visit us. We'd love to see you on June 23rd at 6 p.m. How'd I do, Maggie? Beautiful. Are you ready to do this presentation next week? Maggie, our intern, says she's ready to do unrelated debt finance income tax next week. All right, guys. So that's going to be the new present. No, I'm just kidding. I just like to give her a hard time. Thanks, guys, for joining us. Give me some time to look at all those questions, but I will answer all you guys. And I appreciate you guys tuning in. We'll see you guys next week.